Is intraday algorithmic trading profitable? When people ask me whether intraday algorithmic trading can be profitable, I always recall the moment I first saw an algorithm process hundreds of data points within seconds and execute a trade with a precision that would take a human minutes. It was fascinating, but at the same time, I realized that behind that speed and automation lies a complex world full of both opportunities and pitfalls. Let me take you through what I've learned over the years of studying and observing the markets. Intraday algorithmic trading, or algo trading, if you prefer, is essentially the combination of two concepts. First, trading within a single session without holding positions overnight, which prevents you from being caught off guard by overnight news. Second, using computer algorithms to decide when to buy or sell on your behalf. These algorithms operate based on rules. For example, when a stock price crosses a certain threshold, when trading volume shifts, or when a technical indicator signals an entry or exit. Why is it so popular? Because computers analyze data faster than the human brain and aren't affected by emotions, fear of losing money or greed when seeing profits. But be careful, it's not just about writing a piece of code and waiting for money to roll in. Profitability depends on so many factors that I'd categorize them into three main areas: technology, strategy, and psychology. Let's start with the most fundamental one: technology. Technology. The foundation of everything. Imagine your algorithm has to process stock market data, analyze it, and react before competitors do. When you're trading in time frames of seconds or milliseconds, even a microsecond delay can cost you profits. That's why firms invest millions in low-latency networks, co-located servers directly in exchange data centers, or quantum computing, which promises a revolution in speed. A fascinating example is the use of artificial intelligence, AI, and machine learning. These tools can detect patterns in data that the human eye would miss. For instance, a model trained on historical stock prices might predict that if crude oil futures drop by 0.5% within the first 5 minutes of market opening, there's an 80% probability of a buying surge in the following hour. Or an algorithm that monitors tweets about Tesla and instantly reacts to shifts in sentiment. Strategy. Where success is determined, technology is just a tool. How you use it depends on your strategy. I know traders who focus on high-frequency trading, HFT, which is like Formula One racing in trading. Their algorithms exploit microscopic price differences between markets, such as between gold futures and gold mining stocks. But for this to work, you need not only ultra-fast systems but also a massive volume of transactions. For a retail investor, this is almost unattainable. Personally, I lean towards strategies like statistical arbitrage. One example is pair trading, where you identified two stocks that historically moved together, say Coca-Cola and Pepsi. When their prices temporarily diverge, you algorithmically buy the undervalued one and sell the overvalued one, betting that the prices will converge again. In 2024, these methods are increasingly enhanced by alternative data, such as analyzing satellite images of retail store parking lots to estimate future earnings. Then there are the classics like momentum trading, where algorithms ride the wave of a trend. A well-known example is the opening range breakout, or strategy, which targets stocks with high volatility at the start of a session. A study on the US market showed that orb strategies generated over 1,600% returns in 2024 for so-called stocks in play, stocks influenced by news events. However, these strategies require precise timing. If you get it wrong, momentum turns into a trap. Real-world stories. From successes to disasters. Whenever I talk about algo trading, I'm always fascinated by the story of Renaissance Technologies. Their Medallion Fund, founded by mathematician James Simons, has been generating returns of over 30% annually for decades. Their secret? A combination of machine learning, quantitative models, and data analysis that others overlook, such as how weather affects retail sales. But not all stories end well. Remember Knight Capital in 2012? Their algorithm caused a $440 million loss in just 45 minutes due to a coding error that sent uncontrolled orders to the market. This disaster is a warning. Even the most brilliant algorithm fails if you don't have system redundancy and proper testing. Risks that are often overlooked. When people get excited about profits, they easily overlook the risks. Take slippage, for example. A situation where an algorithm plans to buy at a specific price but executes at a worse price due to low liquidity. Or technical failures. Imagine your server crashes just as the market starts to plunge. Then there are psychological traps. Overfitting a strategy to historical data is a common one. I once built a model that performed exceptionally well on test data from 2010 to 2020. But in live trading, it failed because the post-pandemic market behaved completely differently. Another common trap is the illusion of control, believing that an algorithm will handle everything for you, leading to a lack of risk monitoring. Where is algo trading headed? I see the future in the integration with decentralized finance, DeFi. Already, algorithms on platforms like Uniswap are automating market making using automated market makers, AMM. Or consider personalized AI. Imagine generating a trading strategy tailored to your risk tolerance and favorite markets. But this also raises ethical questions. What if algorithms dominate markets to the extent that they destabilize the economy? Or if someone exploits AI to manipulate prices? Regulators are already working on rules, but technology always moves faster than laws. So, is it profitable? The answer isn't black and white. If you have access to cutting-edge technology, deep market knowledge, and discipline in risk management, then yes. I know people who make a living from algo trading. But for most retail traders, it's a marathon, not a sprint. It requires time to learn, test strategies, and most importantly, humility. I've experienced both successes and failures. I remember the day when my algorithm made an 8% profit in an hour, but also the week when an unexpected central bank intervention wiped out 20%. The key is to never stop iterating. Markets evolve, and what worked yesterday may not work tomorrow. If you're interested in algo trading, start with small steps. Test strategies on a demo account, study case studies, and most importantly, don't fall for myths. Automation isn't a magic wand, it's just a tool. Profitability isn't determined by the algorithm itself, but by how you use it. Thanks for watching.